Recording is on, so now we'll start. Okay, so as I said, accounting is the key component, guys. Without accounting knowledge, you cannot survive, right? Without accounting knowledge, you cannot even sustain in this industry because you're looking for your career in accounting, so it means you should know the nut and bolts of accounting or finance, I would say. All right. So, if I talk about accounting, it means your record keeping system, right? So, your accounting is based on your data. And when we say data, it means in finance, your data would be like expense, whatever expenses that as a, let's say, fund manager or as a, let's say, entrepreneur or businessman, right? So we'll have certain expenses, all right? And apart from that expenses, you would see losses also, correct? Losses on certain transactions, all right? Then income, gain. But to prove that you have, let's say, certain amount of expenses, or to prove that you have incurred some losses from the transactions, or let's say to prove that like you have an income on your assets, or to prove that like you have a gain on investment, you should have a documents in place, because without documents you cannot go ahead with accounting entries. And when we talk about documents, so most important documents as a reference is bank statement or investment statement, that provide you the in detail insight about income and gains and expenses and losses. Apart from that, so you might see certain things like let's say investment that you're holding, right? Then assets which you have purchased, and let's say record it or stored it somewhere else. It can be digital asset or it can be even physical assets also, like furniture, your buildings or equipments, technology. It can be anything, or it can be your digital assets. When we talk about digital asset, it means it can be your securities. Securities, it means bonds, debentures, uh, even crypto assets. It can be anything, right? So again, that reference also you can take it from the bank statement as well as investment document, or maybe agreements or receipt notes. See, as an accountant, if you don't have a backup, you cannot go ahead with accounting, or you cannot go ahead with even preparation of financial statement. And that's what data plays crucial role, right? And if you don't have a data, as I said, you cannot go ahead with accounting. The data, it should backed with the statements, it should backed with the agreement, it should backed with the certain receipts at least, which can prove that yes, you have a certain amount of expenses. Otherwise, how will you record it? See, oral things that won't work in accounting business. Let's say you're an entrepreneur, and if you come up and let's say I'm your accountant, and when you, let's say, come up with the query like, hey, can you record the 1 CR transaction in the books as an expense? See, this particular oral transaction, even if I record, then auditor will not perform audit. That will caught in audit, and then auditor will raise this red flag or concern over the transaction which we have recorded, and it may lead to the fraud or fraudulent activities as well. And that's what data with the backup and proper let's say statements and agreements that help us to bring more transparency in accounting business. And that's what data plays crucial role. But when you have a data, right? When you have a data, so that data it should categorize in a counting. We have a two different approaches. One is primitive approach, so that you can say traditional approach, and recently one another means another approach which I have seen, which is modern one. And how we can differentiate, like traditional accounting, it was based on golden rules of accounting. Traditional accounting, it was based on golden rules of accounting, and as we know that there are different golden rules, like real, nominal, and personal. Personal account, nominal account, real account, debit what comes in, credit what goes out. Nominal, debit, expense, and losses. These are rules. See, rules we cannot modify it. Rules will have to understand as a rules only. So if you modify and then if you try to understand, then you cannot link it. And then credit, it means income and gains. Personal rule, which is debit the receiver and credit the giver. So this is comes under your traditional approach. Traditional approach. Real, it means under real you can categorize your total investment. Like equity, bonds, debentures, alright, options if you purchase it, swaps, right? All that you can categorize as a real accounts. If you purchase, so it means of course that you can record it as a debit side. Debit what comes in. If you know that means data, if you categorize it and if you know it, right? Data types like let's say real, nominal, and personal, then easily you can prepare accounting entries. So under real accounts, under real accounts, so debit, it means basically it's a purchase transaction. Purchase transaction, right? And when you purchase it, what happened exactly? Just try to relate. When you purchase something, of course, something it will come in business, right? Come in business. And when something come in business, and if it is a real, so it means that you can directly record it to the debit side. For example, let's say equity. As I said, equity that comes under real. Total means total bonds or all money market investment, money market investment, or all derivatives market transaction, all assets. It can be anything, including even investment in loan also. Investment in loan also. So all are the part of your real account. And if you purchase them, then what will happen? So when you purchase anything, that things it will come in your account and money will go out, right? And money is also part of your real account. Money is also part of your real account. When you purchase something, what happened? Goods or services comes in, comes in and cash will out. Now same logic that you need to apply whenever you see the transaction, like let's say fund manager purchase equity, fund manager purchase bonds, fund manager purchase let's say money market investment, right? Fund manager purchase let's say investment into cryptos, fund manager purchase FX contract. For you it's a purchase, it should be purchased only. Why? Because you're an accountant and you should check the movement, cash movement. If fund manager purchase anything, what happened? Of course, cash will out from the business. And if cash will out from the business, so simple. So anything, if you see, if anything goes out from the business, so it means when you sell the assets, right? When you sell the assets, again that assets will out. And apart from that, with the sell, if you sell something, what happen? Sell will be your out, means that assets or services it will out, right? Or remove. Services it will out. But what you will receive in your, when you sell something, of course, cash will come in. Cash will come in. And now if I ask you to put it into this journal entry, see, first of all, don't forget this rule. When you purchase something, that things will come in, but cash will out. When you sell something, cash will come in, but that things it means investment, it will out from the business. Now, same rule you can apply while preparing the accounting entries in the books of account. For example, let's say if I ask you to prepare accounting entry for let's say purchase let's say equity purchase equity, let's say worth of rupees on cash. If I ask you to prepare accounting entry for this, see, first of all, read the transaction. Purchase equity worth of rupees $10,000, right? On cash. So it means there are two accounts. One is purchase account, and another one is cash account, right? So go to the this slide and just apply the rule. Debit what comes in, because purchase it is a part of real account, and let's say equity, here we are talking about equity, just apply it. When you purchase something, purchase it will be debited, so record that purchase as a debit. Purchase account debit. 2. Again, go back and check the rule, right? When you purchase, then cash will out. So it means eventually cash it will out. So cash you need to record it, and whenever cash will out, or your assets goes out, so that would be by default that you need to record it to the credit side. Cash account credit amount. See this. Now how this looks like in balance sheet. Same entry, if I ask you to put it into balance sheets. Let's say this is your balance sheet, right? Let's say you have an investment received, cash, which is already that you have it as a capital of a fund. You have this. So it means cash you can record like this in the balance sheets. It looks like this. And when you utilize this cash, because see, when you purchase something, so ultimately cash will out. Cash will out, it means this cash will remove from your balance sheets, and ultimately your investment. Purchase, it means this is your investment. Investment worth of rupees 10K, it will add in your balance sheets. So normal buy and sell transaction that won't affect. Capital is equal to your total assets. It will tie it, and that won't create any impact on net assets value of a fund. So this is how your journal entries, which are directly linked with your financial statement, so that help you to uh, prepare your financial statements. But if you don't know how to record entries, then always you would struggle to understand even financial statements and their challenges as well, right? And most important aspect is we were discussing about real account. Now I'll quickly, give you, technique so that help you to understand how real account works, right? Just, read carefully. Here we are talking about bonds. Here we are talking about, let's say, market instruments, right? Here we are talking about the assets, right? But apart from this, real accounts credit side, we can also record liabilities as well, liabilities of the business, right? Whatever liabilities that fund has, let's say all payables, that we record it to the credit side. All receivables, we record it to the debit side of real account. All receivable, it means all, like let's say dividend receivable, interest receivable, we record it to the debit side. All payables, management fees payables, expense payables, total expense payables, that we record it to the credit side of the fund. Now, if I say your real account, it means your balance sheets. Would you agree with this? Real account represent your balance sheet. Balance sheet represent the real situation of a business. Payable, receivable, total assets, total investment value, right? So your balance sheet represent the current position of your business, but your real account represent to your balance sheet. And that's what now, if I decode the balance sheets, see this should be your asset side. Asset, it means your debit side, and liabilities would be your credit side. That's what I was talking about. So it means your real account, it means your balance sheets. If you see total investment, we record it here, debit side, like equity, bonds, options, then loans, agreements, right? Cryptos, dividend receivable, cash, cash at the bank, prepaid expenses, all transactions we record it to the asset side. And now if I talk about liability side, means credit side, capital always we record it to the credit side. Don't forget these rules. Capital always we record it to the credit side. Then all payables, right? Here we record all receivables, including your subscription receivables as well.
Sorry to interrupt. Where I can see but unsettled trades will be in the asset side only, right?
Which one?
Unsettled trades, unsettled
No,
outstanding trades.
I'll come to that point. So that depends. We have a trade date and settlement date accounting. So that depends, right? Which
Okay.
accounting method that we are following, on the basis of that we can record it. So capital, all payables including your all fees and even income received in advance or any advance payment if you have received. Advance payment if you have received from investors, you can record it to the credit side. All payables, management fees, expense, or any expense if you see which is pending or yet to make a payment, so that you can record it to the balance sheets. All pending expenses, all pending incomes, all current investment which you have, let's say, hold it, all that you need to record it in the books of fund. All means all, right? So advance payment if you have, let's say, received from the investor, that you need to also record it in the books of fund. So it means capital, payables, advance payment, and apart from that any loans or advances if you see, loans and advances if you see, that also it needs to be recorded to the credit side of the fund. But here if you see advances and all payables, it means sometime the wording which you would see like due, due to broker. In a fund accounting you would see wording like due to broker, redemptions payable, and admin fees or other expenses, or maybe in a private equity you would see wording like distributions, distributions payable, or here capital call. Capital call receivable. Now go back and just compare this real account with your balances. See, all means credit transaction. If you compare with the credit side of real account, see this, all payables or all liabilities that we recorded, as I said, all liabilities we recorded to the credit side of the accounts, and all assets, if you have any assets, we recorded to the debit side. Go and now check it. See here, if you compare, we have recorded all assets or receivables or even prepaid expense to the asset side of the balance sheet, and capital plus all liabilities we have recorded to the credit side. Say this. So in short, your real account represent the balance sheets of a business. Now question would be like, why, means what is the importance of balance sheet? See, balance sheets provide you uh, the input about free cash, free cash, then your total aggregated assets and liability balances, and even more transparency on all accounting parts. Right, so that easily you can evaluate that how much cash that you have, or how much cash it can be realized or received in next 1 month, or maybe next, let's say, 1 quarter, or maybe 1 year, so that you can predict or forecast with the help of balance sheets. And that's what a balance sheet is important. But if you see your real account, as I said, that represent your balance sheet. And now I'll come to the accounting entries. See, accounting entries are very simple. After this session, whether you are from commerce background or not, that doesn't matter. What means academics that you had, that doesn't matter at all. Only see the rules. If you receive anything, that will be debited. If goes out from your pocket, that will be credited. Same logic that you can apply. And if you see, if you want to become a pro in fund accounting entries, or let's say entries, whatever entries that that you prepare, means in day out. So it's not a difficult one, but if you just put a logic, your accounting, the debit rule also guide you for the same. Like when you purchase something, it should be debited. When you sell something, it should be credited. Your balance sheet also represent the same. If you see, your balance sheet also represent the same. Total assets, it should be debited. If you see any receivables in near future, it should be debited. And your liability side, let's say credit side, that also contain the same information. So it means if you have, let's say, capital receive, it should be credited. Or let's say if you have any payables, or any loans or advances, or any due amount that needs to be make a payment to the brokers, that all it should be recorded credit side of the, let's say, balances. So it means here the logic is, see, real accounts credit side, and your balance its liability sides, both are same. And real accounts debit side and balance its debit sides, both are same. And on top of that, when you purchase something, or when you sell something, or when you receive something, just follow the simple rule. When you sell, let's say, assets, what happened? Assets will out from the business, and basically that assets will remove it from the your balance sheets, right? So, and that's what, if you remove any real things from your balance sheets, that will be your credit side, right? So as it is, you can record it to the credit side. And when when you sell something, cash will come in. Again, cash is the assets, right? But if I ask you to prepare accounting entry, so your logic should be, where we record the cash, debit side of balance sheets, right? Where we record the assets, debit side of a real account. And now if I ask you to prepare the accounting entry, same logic that you can apply. Cash is the assets, and assets we record it to the debit side. So record it to the debit side as it is, cash account debit. When you sell something, what happened? When you sell something, what happened? Assets will goes out, and whatever goes out from your business, you can as it is record it, like sale of assets, account credit, whatever amount. If you see $2,000, so record it $2,000. See how it is simple. If you want to become a pro in this accounting, means posting accounting entries and all, then see, you should know whether your real account rules. If not, then at least balance it, means where, how we record, or what we record on debit side or credit side. That's it. As it is, then items you can record it. For example, if I take the another example with the same logic, let's say if I take the example for capital, when you received capital, how we record it. So capital always categorizes when you capital received. What happened? Capital received. What happened? Cash received. And you also capital also received it. Capital also received. Right? And as I said, capital that you can by default, means you need to record it to the credit side. So basically credit side, it means it's a liability side. And cash, when you received cash, so by default cash should be your debit balance. So record it to the debit side. And now if I ask you, like, let's say limited partners in private equity, limited partners paid capital call, let's say call worth of USD. If I ask you to prepare accounting entry of this transaction, so it's a very simple. You see, don't need to mug up anything. Just apply your logic with this. Okay. If you see the logic, let's say in this particular transaction, which I can see two accounts. One is cash account, and another one is, of course, paid capital. So it means capital accounts. And there is a word which is call. Add that call word. That's fine. Capital call. Right. If limited partners paid it, it means fund will receive that. And if you prepare, let's say, accounting entry in the books of fund, so your accounting entry should be cash account debit to capital call account credit. So it means you can prepare accounting entry in this way: cash account debit to capital call account credit, with the amount, whatever amount which you have. See, it's not a difficult one. See, as I said, you should know either means your rule or maybe either balance it. Balance it is the modern approach basically. If you go ahead with the balance it, that becomes your modern approach. If you know where to record capital, or if you know how to or where to record assets, right, then you can apply the same logic. Then cash you can, as it is, recorded to the debit side, and capital as it is, you can record it to the credit side. Even rule also guide you for the same, and even though if you go ahead with the balance sheets, that balance sheet also guide you for the same thing. But yeah, so this is how you can record it. Same logic. Now if I ask you, let's say another example with this, let's say distribution of capital. In a private equity you would see distribution of capital, and in an interview also 110%, I'm sure that you would expect accounting entries on capital call and distributions. Basically it's like a redemption. In a mutual fund you would have heard about this redemption, and in other word, distribution, it means it's a return of capital. So that will return the capital to the investors along with the capital gain, interest payments, or if you see any other benefit as such, that we need to return it to the investor, right? That we need to return it to the investor. And if you see, let's say in case of distribution, what happened? Of course, debited would be your capital. Why debited would be your capital? Because in first case capital was credited. When you distribute it, capital will out. In this case capital will out, and that's what it should be debited. But when you return the capital, then what happened exactly? Because this is a vice versa condition. When we had received capital, so actually we had received cash even, but when you return the capital, then your cash will actually out. Capital also it will out, and cash also it will out. Right, and that's what sometime you would have seen, like, in here mutual fund or basically hedge fund, subscription and redemption won't affect on net assets value for per unit of a fund. Total assets will change, total capital will change, but per unit impact on NAV for per shares, it will not change. Why? Because capital and assets both it will reduce proportionate way. Both will reduce by, let's say, 10,000 to 10,000, 20,000 to 20,000. For example, let's say if I say fund manager has received, or fund GMT fund has received distribution later from, let's say, investor LPs for USD. Now you know it, distribution, it means it's a return of capital, it's like a redemption, and that redemption you need to return it means cash that you need to return to the investor. So now return that cash to the investor. So when you return that cash to the investor, what happened? Actually, distribution, it means you are returning capital. So first impact you should apply it on capital. So capital it will reduce, right? And second impact, of course, that capital you're going to make a payment out of your cash, whatever cash you have available with you. Same logic you can apply when you make a payment of my fees. Of course you would have make a payment from your bank account, right? And ultimately when you make a payment, so there should have impact on your total balance as well. Let's say beginning of the balance was 1 lakh, but when you make a payment of 30,000, so your updated balance should be 70,000, right? So just apply that same logic when the fund manager initiate that distribution or return of capital to the investor, then cash will out, so total balance will reduce, and that's what it needs to be recorded as a credit. But if you ask me accounting entry what will happen, so it's a simple distribution of capital account debit to the cash account credit. Say this, as it is distribution means debited, recorded debited. I have just followed rule, right? I have just followed rule. And even cash, if you see, cash account credit, when the cash will out, that you need to record it to the credit side. Just apply rules, don't forget this rule. And now if you want to become a pro in this all these complex transactions also, I'll give one tip so that you can follow. Whatever expenses that you, let's say, make in day out, means whatever purchase or sales that you do, right, for your daily expenses, why don't you try to record them in the accounting manner? Let's say if you make a payment for let's say petrol or oil or maybe whatever expenses if you make up throughout the day, so why don't you prepare accounting entries for that particular transaction, like expenses account debit to cash, or income account debit to cash, or cash account debit to salary, or maybe let's say payment whatever process, let's say for insurance, right, or maybe for tuition fees or any transaction as such. Do it on a daily basis in a regular way. If you follow this practice, you will not face any difficulties with accounting entries. But yes, those means most of the accounting entries, that even if you see, it will means you will see questions around them in your interview process also, around capital call, distributions, how you prepare the entries. Means they can provide you scenarios like this, let's say distribution letter received from XYZ, how we can record them in the books of fund. Tell me the accounting entry. But yes, you should tell them accounting entry in this way. Maybe you would see accounting entry around investment as well, fund purchase investment, right? Same logic that you can apply real account. Don't forget this debit and credit. It might seem it's a basic one, but as I said, it's not a basic. The debit and credit works at very advanced level. If I now talk about, let's say, sell of investment, fund manager sold investment in options worth of rupees let's say this amount. Now if I ask you to prepare accounting entry, see, always you should try to read the transaction carefully and identify the accounts, means how many accounts are involved in that particular transaction. And in fund accounting business, you can refer one bank statement, and investment statement from broker actually. So that provide you means investment statement provide you update for sell of investment details. And basically bank statement provide you details for cash in and cash out. So on the basis of that you can prepare accounting entries. If let's say your bank account provide you insight for cash in, and let's say uh, bank statement sorry broker or investment statement provide you information for that investment has been out, so simple, then your accounting entry would be cash account debit to sell off investment account credit. See how it is simple. It is simple, but if you don't practice, then it will difficult. Any questions so far, guys? Come on. Any question? Anything?
Yeah, all okay so far. I have no questions.
Okay. So it means, in short, if I brief about, let's say, that uh, this real accounting rules. See, real accounting rules. It means your balance sheets. So that represent your balance sheets of the fund. All right. So you can apply the same logic. But don't forget this debit and credit rules. And apart from that, I'll give you another rules about the assets, right? So this will apply to the all assets transactions. All means all right? Assets transactions, all assets. First, the important is what comes under your assets, like prepaid expense, then purchase of investment, and different financial instruments. So that comes under your asset category, even cash, right? So here you can follow the rule, which is all right. So assets, if your assets increases when your assets will increase, of course, when you purchase it, in that case your assets will increase. So it means by default you can record that transaction to the debit side, right? And if your assets decreases, right, when your assets will decrease, of course when you sell it will decrease. Apart from it means wear and tear, or wear and tear, it means basically if the value of assets depreciate due to xyz reason, in that case there would be a little bit different scenario. But when you sell the assets, of course it will decrease, and that's the reason you need to record it to the credit side. So now you can apply the logic. When you purchase something, it means your assets it will increase. When you sell something, it means your assets will decrease. And same logic you can apply with the cash as well. When you purchase, of course, cash will out. And if cash outs, that would be your credit record. And here, when you sell something, cash will in, and that becomes your debit record. And same rule you can apply to the all the assets. All the assets, it means all the assets. All right. Then same logic you can apply in case of liabilities also. liabilities as well. All liabilities, like all fees, or all redemptions payable, or any expenses if you see that needs to be, processed or transferred to the counterparts, that all comes under your liabilities. And if you see any liabilities as such, it needs to be reversed or processed or returned to the investor, or maybe let's say counterparts, or to any vendors and all right. So in that case, what happen if your liabilities increases, liability and capital, you can apply the same treatment to the capital as well as liabilities. So if your liabilities, let's say, increases, means funds liability increases. And why liability will increase? In case of capital call, liability will increase. In case of subscriptions, liability will increase. And all payables, expense payables and all, right, any payables if you see, that will lead to the increase in liabilities. And if that is the case, then by default you can record this to the credit side of the accounts. If your capital and assets increases, then you can record it to the credit side, and vice versa. If your distributions, redemptions and all payable, if let's say reduced, so it means if you make a payment or if you reduced it, by default that would be your debit balance, or you can record it to the debit side. For example, let's say you have redemption confirmed, so your accounting entry would be redemption account debit to cash. You have a, let's say, fees which is confirmed but yet to make a payment, so it means you're payable, right? Then your accounting entry would be expense account debit to payable account credit. And when you make a payment of payable, then your accounting entry would be payable account debit to cash. Don't forget these rules. If you forget these rules, then you cannot prepare journal entries. And trust me, in your interview process, you may expect 30 to 40% questions around journal entries only. Why? Because journal entries are critical. Only the JV, means JE, journal entries part, which you would see, which is a manual, and rest, it's an automated process. Once you processed or post journal entries in the books of fund accurately, ultimately your system will prepare PNL, system will prepare balance sheet, system will prepare trial, system will prepare everything, and further job would be like to just verify and make a adjustment, necessary adjustment if it is required. All right. Any questions so far? Are we good on this? Because after this I'll send you assignment, I'll check your knowledge as well, so you will have to apply the same logic.
Yeah, I have no question.
Okay, so now I'll quickly brief about the real accounts, nominal accounts. But before that nominal accounts, I'll quickly walk you through the real accounts. Real accounts, it means it's advanced, not personal, real, nominal. Personal account, we have already covered about real accounts. Now we'll discuss about personal. See, personal account basically for your credit transactions, right? Credit, purchase and credit sell. So when you make a, let's say for example, you have a transaction where, for example, fund purchase shares worth of rupees on credit. Fund purchase shares worth of rupees 1000 USD on credit, let's say from JP Morgan Bank. So if you see, this becomes your counterparty or entity. Personal, it means basically it can be person or it can be your artificial entity, right? Artificial entity. So that you need to record it. That you need to record it in the books of accounts to have a better transparency in place. And the important part is here, when you purchase something on credit or when you sell something on credit to anyone, so by default your counterparty name, it will come in picture. So same transaction, if you see, book it under credit purchase. When you purchase something, what happened? Of course assets will come in business, so it means debit your purchase, that you need to record. And of course by default your counterparty name goes to the credit side, let's say JPM account. JPM account. And if you don't want to record the JPM account, then you can record it as a payable. Basically it's a payable, it means liability. Payable account credit. So it means your accounting entry would be purchase account debit to JPM account or payable account credit. So basically your personal account help you to manage your credit transactions or to record the credit, let's say business transactions in the books of your records. Most of the credit transactions, most of, or I would say 100% your credit transactions were recorded by following personal accounts rules. Now you just related what could be the different transactions, means credit transactions that we would see in the books of account. All or most of the transactions, if you see any transactions, if it is let's say on credit, that transaction it should be recorded to the in the books of account by following this personal accounts rules. All right. Or now if I let's say if I talk about nominal accounts rule. Nominal account rules, if you see how nominal account works, debit expenses and losses, credit income and gains. If I talk about expenses, it can be your management fees, admin fees, audit, legal, all right, even losses on investment. It can be realized loss or unrealized loss. So it should be goes through the your nominal account process. And now if I talk about let's say income, if I talk about income, let's say your dividend, interest payment, right, rebate received, means discount received. All right. Unrealized gain and realized gain. That comes under your income and gains category. If I ask you now what we record to the P&L, P&L credit side, P&L debit side, what we record? Of course, we record all expenses, losses. Then what about credit side? We record all incomes, gains. So don't you think that your nominal account or P&L both are same then? Right? Both are same, correct? So nominal account, or basically we refer the nominal accounts, what are the nominal accounts in the business, and then we exactly replicate them on P&L. So basically P&L is your nominal account, right? See this P&L, on P&L we record all your expenses. That's what I said yesterday. If you see your golden rules or accounting, if you link them at advanced level, your accounting becomes easy. Nominal accounts, it means your P&L accounts of the fund, so that help you to categorize expenses or to record the expenses and even income in the books of fund by applying dual entry accounting system, which is debit and credit. See this. On top of that, if I talk about expenses only, if an expenses increases, it means, let's say, management fees received, admin fees, let's say, incurred, let's say partnership expenses incurred, so that portion comes under your increased in expenses. If an expenses increases, right? So what happened when expenses increases? So it means expense expense account, it should be debited, and cash account, because cash it will paid out, cash it will be credited by default. And when expenses decreases, basically income will increase. So when your expenses decreases, or if you receive any reversal of expenses, so that becomes your expense. Same expense you can record it to the credit, and cash it will debit. But on top of that, if your expenses let's say increases, then your assets, and in other word like NAV, it will decreases. And if you increase expenses, let's say decreases, then ultimately your NAV it will goes up. All right, don't forget these rules. Same for expense in same rule you can apply, means vice versa, you can apply this rule to the incomes as well, all incomes, or even gains as well. If your incomes increases, if your income increases, what happened? Cash will in. All right, and cash will in, so that you can record the cash to the debit side, and income items, whatever income that you have, that you can record it to the credit side if your income increases. For example, dividend you have received, So your accounting entry would be cash account debit to dividend income account. Interest received, interest account debit to, sorry, cash account debit to interest income account, in that way. Dividend received, dividend received, accounting entry would be cash account debit to dividend account credit. See this. When expense income decreases, what happened then? Cash out, so it should credit, and income, it will be debit. In case of dividend reversal, you are reversing the dividend, right? Let's say you receive dividend and now you are reversing it. Then in that case your accounting entry would be dividend account debit to cash account credit, vice versa. So this logic you can apply while preparing journal entries in the books of fund. Now I'll take one example for interest payment and one example for dividends. All right. So if I take the example for, let's say, dividend, fund received dividend amount, says dividend amount rupees INR. Now if I ask you to post accounting entries in the books of account with this transaction, first you should identify accounts. There are two accounts. One is dividend, it means income account, and another one is, we are talking about cash. Check the activity or movement in fund book. If you see movement in fund book, of course cash, as you have received it, right, or dividend you have received it in the form of cash. So your accounting entry would be, as I said, when you received something, so it means this is the situation where your income has been increased. So your accounting entry would be cash account debit to income account credit. So cash account debit, income or dividend account credit. See, same word if I replace, instead dividend, let's say interest payment received, interest amount rupees, let's say 12,000 received. Your accounting entry would be here same as it is, just add interest income, and your accounting entry would be cash account debit to interest income account credit. So this is how we prepare accounting entries in the books of fund. All right, I'll take one more example with your expense part. Let's say fund has paid management fees. That's rupees 12k. See, paid and received, both words are very important. When we say received, so it means here we are talking about cash in, and when we say word use paid, so it means your cash will out. So by default cash you can record it to the credit side while posting entries, and here by default you can cash record it to the debit side. So don't forget this equation. So here we are talking about paid, it means of course cash which is out, and another account which you would see which is expense, management fees, it means it's an expense account, right? So, and this is the case where when you have paid the expenses, it means your expenses which has been increased. So your accounting entry would be expenses always be recorded to the debit, and when you paid it cash will out. As I said, by default cash you need to record it to the credit side. So your accounting entry would be expense, management fees account, credit X to cash account, sorry, management fees account debit to cash account credit. Let's say amount is, say this. So this is how we prepare accounting entries in the books of fund. You can unmute now and ask your questions. But yes, accounting entries are very crucial. Your 30% part would be your accounting entries. So you may expect a lot of questions on your accounting entries part.
Preparing these journal entries in terms of the interview perspective, right? We're talking about uh, normal BAU.
In normal BAU also, 60% your 60% job would be like posting journal entries. So it means identify differences and posting journal entries in the books of account. It's a routine job because we verify bank statement, we verify broker statement and identify differences and post the journal entries in the books of fund. It's a routine job, means routine job. And apart from that, in an interview also you may expect questions around this journal entries only. Most of the questions should be around this only. Shipra, any question? Because I'm done with this, because we'll discuss means other things as well in next session with regards to this only. I have other things as well, like adjustable entries, prepaid expenses, outstanding expenses, payable expenses, their scenarios. So we'll cover that also. So,
So I have one last question before we wind up.
hmm,
Well, uh, say there are dividends are there are interest posting,
hmm,
interest booking are there.
hmm.
We directly get into that respective module, or we post a journal. We just try to understand the basics, right? So it's a or
See what happened, I'll tell you in reality.
mm-hmm. Mm,
Let's say there is a GMT fund,
mm,
right? GMT fund will open bank account, right?
yeah.
Once the GMT fund will open bank account, then investors, fund manager will ask investors to transfer money to the bank account, right? And then again, fund manager will activate different accounts. Let's say broker account, demat account, right? Or other investments account as well, I would say. Investments or trading accounts.
Mm,
So let's assume it investor transfer this amount cash to the bank account. So fund received it. Let's say your accountants here. Same fund manager asks you to, hey, look, we have received fund. Can you please post journal entries in the books of account? As I said, your entire reporting is based on your journal entries. Then what would be your first course of action? I'm sure you will ask fund manager to share bank statement. Correct? Otherwise, how will you post the accounting entries? What about the backup? See, as an accountant, you cannot post the accounting entry in the books of fund without backup. First backup would be your bank statement. Second, whenever investors transfer fund, so the transfer funds, but before that, fund manager, fund manager and investors, fund manager will initiate side letter, or it can be any uh, any letter which contains the information of cash. Let's say 50,000 cash, 60,000 cash, 1 million, 2 million, 3 million, 100 million, depends, right? Later. So, as a fund accountants, you require two sources. One is side letter, or maybe letter or email communication, which provide you confirmation about the fund, as like why you have received fund, and bank statement. So, bank statements, it's a validation proof, so that you can validate, okay, yes, we have received cash. And notice or later, that also provide you confirmation. Okay, so it means fund manager initiated later, investor accepted it, and then after investor make a payment to the bank account. So you can refer both and then you can conclude, okay, so it means this transaction, which is, let's say, cash you have received, cash account debit to capital call account. So this is how your accounting works. Let's say that same cash now fund manager transfer it to the broker accounts, or let's say investment accounts, right? From bank account to investment accounts. Here cash now added, and let's say fund manager now invested that amount in TCS stocks, invested in TCS, buy TCS stocks and hold. Then your accounting entry would be, again, if fund manager asks you to do accounting, then this time he will ask for investment statement plus bank statement, right? In a bank statement, first entry would be positive, cash you have received. Second would be again cash out, and bank statement provide you the confirmation of payment. And on the basis of that, again you can prepare accounting entry where investment account debit to cash account credit. Let's say after 1 month, you got to know there is a cash amount available in bank account, which is 500 rupees. When you checked it, then you realized, okay, TCS sent one notice. Notice, it means document, reference number, or reference number. It can be MT566. It can be, let's say, formal email communication also, where TCS processed dividend on investment. Then again, as an accountant, you required that document which provide the information about dividend processing payment, and also bank statement where you have actually received amount as a credit or debit balance, whatever it is. Then again you can refer both the sources, save that both the sources in your internal accounting system for auditing or financial reporting purpose, and again you can create journal entries for cash account debit to income account. So this is how your accounting works. Accountants need sources, right? And sources should be your bank account. Sources should be your notices or side letters, so that you can refer and post the accounting entries. Why? Because accounting entries are the basement. So your entire reporting is based on your journal entries, and that's what If you see, most of the job activities would be like posting of entries in the books of account.
Okay.
Got it?
Got it. Got it.
Any other question?
No. Clear.
Okay, all right then. I'll share you one or two documents. Just go through it. Try to prepare the accounting entries, and you can post it in the groups after the preparation. Just hands on it. I'll share you this recorded session as well, so you can again go through it if you want
Okay.
and see.
So you asked me to ask us to go through the special classes folder, maybe right, daily basis.
Yeah.
Okay.
So just share me the course name in in which course that you have means in which course that you have registered. So I'll add the folder there. You can check the folder name which is special classes and just go through the recordings.
Mm. Okay.
I'll create two folders there. One is for special classes and one is for your daily classes. Your classes means weekend classes. So
Okay.
weekend in a weekend classes, I'll transfer your recordings. All right. In a special classes, there is already means there are different sessions which you can refer. Your sessions also you can refer it, and even classes also you can means your classes you can also access it.
Okay.
All right.
So by next week
Diwali.
uh, you are we
Yeah.
are going to. So,
Yeah, you can take a leave, but make sure that you are at least attending, special classes, and I'll give
yeah.
you assignments.
Mm.
All right.
Okay.
So go through that assignments. Try to attend it
Mm.
immediately. I'll send the assignments.
Okay.
So I would request you for that because if you have a gap, then most of the people like they don't follow it. All right.
Mm. Okay, sure.
Let's go through it. We'll connect after the Diwali then directly.
Okay. Okay, sure, sure. Happy Diwali to
Yeah.
everyone.
Happy Diwali to you. I'll send you
Thank you.
this documents or assignments or just go through it. Would be interesting one. Just try to attend it. At least give a try, I would say.
Mm-hmm. Okay, sure.
Right.
Okay, then
Let me
thank
share
you
the
so
recording.
much.
Yeah.
Thank you. Bye bye.